Vikash Jain, Managing Director, Head of Research and India Strategist at CLSA India, speaking to us on all of that and more. Vikash, great to have you on NDTV Profit. Welcome as always. Let's begin by saying if you are also seeing a change in mood as far as Indian markets are concerned in 2026 versus what has relatively been quite a dismal 2025.
Thanks for having me. So yes, you're right that there is some change of mood and there are some reasons for that change of mood. Let's just take a step back and look at what happened in 2025. And in 2025, Indian markets in terms of the perception game took quite a hit. I mean, particularly in the second half of 2025 for the simple reason that initially, of course, 2025 started with the worries around what will happen with President Trump coming in and the tariffs. Even as early as late April, there was hopes, and these hopes come from commentary from people from the US administration and President Trump's administration, the most senior people over there, that India would be the first one to sign a trade deal. From that point onwards to now, India looks like India could be amongst the last few countries to sign a trade deal. So that was a big relegation. There is now a period that China possibly has lower tariffs than India. And in the interim, there was, of course, the sudden geopolitical worry which came in. All of this happening in the middle of a global AI bull run, where India was not at the forefront of AI discussions. So the theme of the bull run, the global bull run, it's been a very powerful global bull run. In fact, we'd look at some 20 to 25 top large markets in the world. These make up nearly a large part of global equity market capitalization. If we were to take a count right now, then the percentage of markets that have made a record high in this calendar year is the highest in this century, almost equal to what we last saw in 2007. So it's been a roaring global bull market on the back of an AI. India did not really offer much onto that.
Yeah.
Our valuations were uniquely expensive when we started the year. So a lot of complaints. What happens from here on is many of those complaints have got addressed. They've got addressed by the passage of time, if I may call it so, because global markets have rallied. Indian markets haven't really done much. We celebrated a new high yesterday, which basically meant that in 13 months, we are back to where we were 13 months ago. So that is essentially what it means is that we've had our derating. And the underperformance that we have seen during this period, where global markets rallied, in fact, our underperformance was the highest on record in this century versus EM versus Asia X. Incidentally, the side effects of all of that was that our relative valuations have become much better. And with passage of time, many of those those bad headlines have got digested, and there is hopes of better headlines. The Indian policymakers themselves have pushed in the positive effects of the initial income tax cut, then the interest rate cuts plus the GST cuts. So all of that have been the incremental positives. So some positives to look forward to: headlines improving, relative valuations becoming more palatable, basically makes the long list of complaints against India a shorter one. And that is where interest is slowly coming back.
Long list against India, shorter one. I think that's an interesting way to put it. Is one of the things on the list, and I don't know if it's a complaint or not, depends on how you look at it, is that this is the non-AI trade. India is the non-AI trade. I don't know how convincing you find that argument.
I mean, see, I would not. So there are ways in which people want to put it. Some of those ways are the ways to catch attention. Some people can call it non-AI trade. Some people can call it anti-AI trade. Honestly, if I were to be a more accurate description of that, would be a trade where you reduce your portfolio factor risk of AI. Let me explain that. All the best markets of the world where people would be involved, where we see highest of momentum, the US, China, Korea, less so Taiwan now, but even Taiwan, a large part, all of them are actually markets where we see the bullish factor comes from AI. So if you own all of those, the factor risk in your portfolio from AI is very high. Now, if you want to hedge against that factor risk and you want to bring in other areas to balance the risk in the portfolio, that's where I think India could stand out very clearly as the most promising story, not depending on AI for its growth itself. I would not call it an anti-AI market or a non-AI market per se. It's just that I would still believe that in the longer term, India could be the beneficiaries of AIs would be the ones who adopt it in the right spirit and to gain out of it. When you have a relatively young population, average age of well under 30, then essentially the ability to adopt to new technology is always very high. We've shown that with our digital payment adoption. We've shown that with our 4G, 5G adoption. So eventually, in the medium term, I do believe that India will find ways to gain from AI. But in this period of, attempting to test and in that process put in a lot of money, of course, Indian enterprises and Indian, policy, Indian finances do not allow you to put in $1 trillion just to try something out. So when there is a clearer case of a use case of AI in terms of the way a broader adoption could come in, I think that's the point where India can come in and adopt very quickly. India has been great at adopting, great at cloning things and making it work, tailor make to its own use. I think at that point of time, I really don't think that India has lost the AI battle to call it a non-AI trade or an anti-AI trade. But yes, it doesn't really have the immediate AI options to kind of fuel the global AI-based rally.
Vikash, good morning. Point well made. Alex here. I want to ask about earnings. And I was looking at your report, and the fact is that a significant number of companies did beat on expectations, but several didn't as well. And I see the point that you've made on the PBT, right? If you remove Tata Motors from the equation, then there would be a beat on the PBT on a blended basis. I'm just wondering whether this bodes well for the second half, particularly because there would have been, in some manufacturing pockets, some implications of the disruption on account of GST 2.0. Does it look materially better than you thought at the start of the year in the second half?
So, Alex, there are two parts. That's why, the way I put it was complaints reducing. There is another report that I did just following that report where we talked about how consensus estimates have moved. And to my surprise, for large caps other than Nifty and for mid caps, there were upgrades during the quarter. Even I did not expect that. Small caps have continued to see downgrades. This is for consensus overall. I'm talking about the breakup of NSE 500 stocks. And overall, the top 100 stocks have seen an upgrade and the mid caps have seen an upgrade. It's the small caps which have seen a downgrade. Now, using that as a read through, I am still not convinced that I can extrapolate that to a point that we should see further upgrades in estimates, for the simple reason that when I look at current expectations of mid caps and small caps in terms of earnings growth, that is somewhere between 23 and 24% EPS CAGR expected over the next 2 years. At a time when nominal GDP is growing by, struggling to go by even more than 9%, because of relatively lower inflation. And mind you, earnings are not real, they are nominal. To get to that will require far higher revenue growth, clearly double-digit plus revenue growth to get to those kinds of earnings numbers. I still do not get the confidence to call for further upgrades to those estimates, and that's why it's been a good quarter. There is hopes that the October-December period should be a good one due to the GST cut. But does that give me, I'm still not finding myself in a position to call for a large upgrade cycles in earnings, because earnings are still quite elevated in my, the large cap earnings have got more reasonable. Their expectation is more like 10-11% growth over the 2-year period on FY27 over 25.
Yeah.
So that's where I see more reasonableness. So all that I'm saying is that the way to look at it is that we had a long period of downgrades. That period looks like has largely behind us. And we are at a point where things look a bit more manageable in terms of earnings estimates.
Okay. Vikash, I wonder what you think about this India relative to the globe and the several markets that have outperformed. There has been significant concentration, right? And we've not seen that in our markets here, despite the fact that large caps of late have outperformed. I'm wondering what you think. Is it going to be broad-based, if at all we see a gain from this point or a rally from this point? And I know, I take your point on the revenue side, right? 6.8% is what the companies that you track delivered, and you were expecting 8.8%, so it's an underperformance. And so even if inflation picks up next year and nominal picks up as a result, we're not going to see tremendous earnings growth. But do you think it's going to be a broad-based gain, if at all?
Well, I think, there are segments of the market, and in particular, small caps in general, where earnings have continued to see downgrades, but multiples and premium versus Nifty has continued to uh, kind of stay expensive, and it's still well above, it's nearly at +2 standard deviation to historical average premium. So, and delivery has continued to lag. So, just to kind of uh, a simple example to say that is when I look at estimates, the distribution of estimates, since you talk of how broad-based the rally could be, small cap estimates for FY25 to 27 earnings growth, more than 50%, almost 55% of companies are expected to grow earnings at over 20% EPS CAGR. If I were to compare that to trailing 12-month delivery of earnings, only one third, that's more closer to 33% earning companies have actually delivered 20% plus EPS CAGR. So there is a gaping hole when you compare the expectation versus what actual delivery has been. So I want to be careful that I do not see this as broad based. You need to basically be careful in picking stocks where expectations are not out of whack. I think that's something which remains, and there are still quite a few sections of the market where I do see that as the case. So, and I do not really expect a big absolute upside of say 15-20% in the market, because that we've already come to a 21x multiple. It's more that negatives are lesser. We see some kind of an upside possible if the global bull market continues. And for people who believe, and all of this doesn't really create any worries on the longer term India growth story. So people who want to focus on that longer term should come back to stock picking.
Okay, so stock picking should be the key from here on. Vikash, good morning. Hira on this side. Interesting point that you made, that you have to identify a couple of pockets that will show growth. Now, you do have the India Bull Bear Index, which is CLSA's proprietary. What is that telling you about, one, the investor sentiment, and two, if you have to tie that up with stock picking, sector picking that you're alluding to, that combination, what is that leading you to right now?
Okay, so the proprietary India Bull Bear Index is being made in a manner that that it is useful only once or twice in a year at max, because the I track sentiment on it, and how you should think about sentiment is you should worry about sentiment only when one side of the sentiment becomes consensus, like everyone gets bullish or everyone gets bearish. If the market is divided, then sentiment is not something which gives you a very clear, useful signal. So that index gave us an extreme bearish signal, which means a contra buy signal at the end of September. And that's when we turned more positive, and in our reports we started calling out for a potential new high in the before the end the calendar year, which luckily played out yesterday. But we've had a good 7-8% rally from that point of time, and the index is now neutral, so it's not giving any incremental signals. So we have not really at any extreme sentiment. But see, that index is an overall view on the market, and when you take an overall view on the market, there's always an influence of large cap stocks, which would be there. But in terms of sectors, we need to try and do a little bit of crystal gazing, where of course that's always fraught with dangers. But if I back myself on how I see the next year to be, then the key areas that we would want to focus on
So
are
Vikash, to
yeah.
add to that, key sectors that you're placing your bets on right now, because you've recently made consumption and rate sensitive stocks a tactical preference. To add to that, the investment capex cycle coming in as well. So top 3 sectors that you would advise investors to look at from here on.
Yeah, so you yourself mentioned the one that you missed. Let me start with that.
Okay.
We expect the headlines to turn positive with a potential deal with the US as well as EU. That India-US relationship headlines turning positive, and recently we also seen President Trump get a little easy on H-1B visa and acknowledging that there is a requirement for that, in certain places, should be positive for IT in our opinion, which has been a sector where we have an out of consensus overweight. So we are playing a few themes. First, India-US related and trade related headlines improving. IT is a sentiment trade on that. Secondly, at the same point of time, we believe that any incremental push from policymakers is likely to be monetary, very unlikely to be fiscal, which means that easier rate environment could very well continue. And that is where we are trying to play rate sensitives for. Third is we could sometime in 2026 get to a point where policymakers have believed that they have done enough through income tax cut, GST cut, rate cuts, and more rate cuts coming. Then they would, all of that should flow in its stronger consumption numbers. And that is the other area that we are looking to kind of be positive on. So those would be the areas where we would want to place our bets.
So much, Vikash, for speaking with us. That's Managing Director and Head of Research, India Equity at CLSA India.